Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast and this Investment Friday edition. I am your host, Hannah Chapman. We are recording on March 7th. It's about 4:45 p.m. For release on March 8th, Friday, March 8th. And this week, I've got Brad Haines with me here again, Chief Investment Officer of Juncture Wealth Strategies. Brad, how's it going, man?
It's going great. How are you?
I'm good. I'm good. Right after we record this, I'm going to eat some pizza and then go to my youngest daughter's first school play that
That
she's
is
in.
so exciting.
She is, yeah, she has been singing and dancing. They're doing it's Schoolhouse Rock medleys, right? So we're going to hear a bunch of classic Schoolhouse Rock
That
tonight.
is going to be fun. Are
Yes.
they doing the Jack Black rendition?
Probably not, but I'm sure that would be, I'm
That
not,
would be
it would
that'd
be
be
fun.
great. Yeah, that would be fun. That would be fun. Well, good for her. Good for her.
Yeah. So what's going on in the
So,
markets this week?
man, we've had a lot going on. You know, we're continuing with corporate earnings, so that earnings season is still rolling through. We had a couple of big tech companies come out this afternoon and do pretty good earnings releases, so that's good. So that should keep the momentum for the stock market continuing a little bit higher. We've had Jerome Powell, the chairman of the Federal Open Market Committee, which is a committee that controls the monetary policy in the United States. He gave some congressional testimony in which he reaffirmed the Fed's guidance that they are going to lower interest rates in 2024, but they want to see a little bit more evidence that inflation is truly going to come down to their target 2% and stay there for a sustained period of time. So again, I think you and I have talked about this a lot. People had anticipated 6 interest rate decreases in 2024. Early on, I said we probably will get 3, and that's probably where it's going to come in. The futures curve, which anticipates these moves in Fed policy, has come down a lot. It's where people have said, well, maybe we're not going to get 6 decreases, but 3 to 4 is probably reasonable. And so we'll see when that all begins. My guess is it's going to begin second half of the year, and it'll be really dependent on what core CPI and the PCE, the personal consumption index, where they come in at. We also had some great news on the JOLT survey, which the JOLT survey is the job openings layoff turnover survey. So it's a survey of companies that are hiring and firing and people that are quitting voluntarily or retiring. It's kind of the what's available, what jobs are actually available for people in the United States. And we take that number and we compare it to the number of unemployed individuals in the United States. And just to reiterate or to remind our viewers, that number had peaked out a little over 2. So what that means is when it peaked, there were 2 available jobs for every unemployed worker in the United States. Okay. So that's a big deal. That's a lot of jobs. And that's when we had kind of those higher inflation numbers coming in. Our most recent reading is less than 1.45. So that means little less than 1.5 jobs per unemployed worker. Still really, really strong. Labor market is still very, very tight, but it is softening a little bit. Finance and tech, those layoffs are still rolling through as they kind of right size their labor forces, given what happened in the pandemic. Everybody hired everybody, all these people, and then all of a sudden now they're realizing maybe the demand isn't as high as they anticipated, so they're rationalizing those workforces down to where they need to be. So that, why is that a good thing? Well, when the labor market's too tight, it means inflation is going to be too high. Too high of inflation is not a good thing, obviously, as we've experienced over the last 3 years. And so with a softening in that labor market, that makes inflation much less likely to persist, which means we can have a great lower inflation, higher GDP growth rate, which again is pretty good for the United States.
So one question that I have been asked a few times with regards to job openings and whatnot, and I think it's a fair thing to ask, is that when we're looking at the job openings that are being reported, are those full-time positions with, jobs that would pay a living wage? I think that's
Yes.
one of the
Oh,
questions.
so that's difficult to assess because a living wage, uh, what that is different for almost every person you ask.
Mhm.
And it varies widely across geographic regions. For example, a living wage in small town Arizona, let's say Jerome, Arizona, may be very, very different than a living wage in Manhattan, New York.
Right.
So that's why it's a little bit difficult to assess on a national basis those jobs. What I would say is that um, wage growth, which was not great pre-pandemic, has actually picked up nicely and been averaging 4.5 to 5% since the pandemic.
Hmm.
Now, what that does is it allows consumers to earn more money, right? And as they earn more money, they can be supportive of spending. Um, for the most part, those jobs are full-time jobs, and that's it. That's all we
Okay.
can really say about them. Are they the lower skilled? Yeah, those are included, but they also include higher skilled, higher wage type jobs. So it really is dependent on the person. And so from a living wage, it's difficult to say. Um, I mean, my guess is almost every household has to have one or two jobs to pay, just to live, to pay
Yeah.
their bills and live a decent lifestyle. Um, but there's lots of people that make that sacrifice where they want to have one job and just go towards that lower. They just don't spend as much money as other people could. So
Well,
so
and
I don't know if that helped or not, but that's kind of all I can say about it.
yeah, well, I think that is helpful, at least in that, um, to understand more, so these surveys, because the Fed is making policy based on, the data that they're receiving, but at the same time, it's not necessarily saying that, like, if you were earning 125,000 or $150,000 as, a software engineer and you get laid off, that doesn't necessarily mean there's one and a half positions open per $150,000 per year software engineer, right? This is saying that's all the way across the entire economy, whether that's, working at a full time at a fast food restaurant or full time at Johnson and Johnson. Like it just, it just doesn't, it doesn't have a, it's industry agnostic, I guess is what I'm
Yeah, that's a
getting at.
that's a good way of putting it. What I would say is they do track by industries, by educational levels, and by income levels, those jobs. So the Fed does track that stuff to be where if all of a sudden all the jobs were these really low paying jobs, they would know that. Okay.
Mm,
Um, Now the JOLT survey doesn't differentiate between those, but well, the headline number doesn't, but the Fed does watch that to make sure that, because that is one of the things that you have to be careful of, because as 70% of the US economy is generated by consumer spending, if you have a ton of these low income jobs and nothing on the upper tiers, then that affects how much consumer spending you can forecast in the future. So, and what those things are spent on. So, what those dollars are spent on. So, it's something that they do track. But from a headline number, the one we're talking about, it's agnostic to educational levels and experience level and income levels.
okay. So this one, to like summarize that number has come down quite a bit, from a high at two jobs per unemployed person down to 1.45
Yep.
per unemployed person.
Yep.
And so that on the face of it is pointing to lessening inflation if it keeps up.
Correct. Correct. Now, just to give everybody some perspective, the 20-year average of numbers of jobs per unemployed person is 0.6.
Okay. So we're
So
still
just
way above that.
we're still double that. We're over double that. So we're still in a really good labor market. That's what I was saying. This is still a really good labor market for workers if you're looking to switch jobs or if you're looking to get back in the workforce. It's a great time to do that. However, um, it is coming down, and we're particularly excited about some of that softening, just because indirectly that does influence inflation, and inflation being too high is not a good thing for anyone. So
Well, from that perspective, let's shift a little bit over to what we were talking about before we started recording, which really got into more of the um, real estate market and what we've been seeing there. You were talking about something that I hadn't put these two things in the same bucket yet, or kind of like looked at the span of retail real estate, like strip malls, malls, um, all of the like the developments, right? I don't. So I used to live in Arizona. I live in Ohio now, and in both places, these are very far apart. You can see a plaza with a Target and a Michaels and a Best Buy, right? Like that particular retail grouping. Um, Seeing that like duplicated all over the country, right? And we saw a ton of that for a good couple of decades. And then over the last 10 years, as you were explaining, that we've seen a bear market in retail real estate. And so I'll let you pick it up from there about, kind of what that means and what we're talking about.
yeah, I mean, so what gave genesis to that conversation was New York Community Bank, NYCB, which took over Signature Bank last year, has a lot of exposure. This week they came out. They have a lot of exposure to commercial real estate and to particularly to some residential real estate in New York City that's rent controlled, and then also some office space, which is not as productive as they would like it to be. So their stock prices suffered. They were down 80% at the time of the announcement, the year to date, and so they had to get some funding from some hedge funds or some private equity groups for $1 billion to kind of give them the time to work out some of these issues. Um, and what I was saying was there's very much a fear across the investor group that any bank that has any exposure to office commercial real estate is going to go down in flames. And I don't think that's what's going to happen. I think what's going to happen is very much like what happened, you mentioned, to retail real estate. Retail real estate was in a massive boom. We built all these malls, we put tons of strip centers in, and that's great. It went through a huge bull market, but then people started to shift their buying patterns. They started to go online. Amazon went from a bookseller online to the worldwide marketplace for whatever you want to buy, right? And as the percentage of people's spending went online, you didn't need as many retail office or retail centers. And so what did you started to see certain malls shut down. In Phoenix metro area, we had the Metro Center, which was kind of one of the center attractions of malls. They have an amusement park attached to it almost, and it was a pretty cool in its day. It was a really cool place. Well, it now has totally shut down, and they're repurposing that property to be more productive because people aren't going to the malls anymore very, very much. And so now that is essentially what's happening to office, right? The pandemic forced a transition in technology to be where maybe we don't need as much office space as we currently have. Maybe there's a way to rationalize it in a better way as people are working from home. I mean, I think the average large company now has 3 mandatory days in the office and 2 flex days. So if you just look at that, well, 3 out of 5, 60% of your time you're in the office, there's 40% where you don't need as much retail space. So, I think that rationalization is going to happen over 5 to 7 years, 10 years, maybe, where office CRE goes through this protracted bear market until we get to the point where we find that, where supply meets demand, and the new modes of doing business with, flex working arrangements and the like are fully integrated into the U.S. economy. Right now, we're just going through that transition period, and I think more people are very concerned about it. Are there going to be some weak banks that get taken down by having too much office commercial real estate on their books? Very possibly. Okay, very, very possibly. But on the flip side of that, I would say there are some private equity groups which have a lot of cash on the balance sheets right now that are looking for those opportunities because they can make a great deal. The group the groups that funded New York Community Bank, NYCB, are I'm sure going to make a ton of money on those deals. So good for them. Those are great deals, and it's something to not be necessarily afraid of, but it's definitely not for the faint of heart, and it's definitely not for an amateur investor to do that.
Well, and what you're speaking to also is like a really long time horizon too, right? So if someone's buying office real estate right now, or even retail real estate, like that shift that happened over time, there were a lot of people that went bankrupt, right? Like, as you were talking about that Spirit Halloween came to mind, right? How any empty retail spot, you're like, oh, now that's a Spirit Halloween once a year.
For sure. That is exactly true.
Right. But people are figuring out how to modify some of these spaces, right? And those ideas are starting to come out. And so what I hear you saying is that office real estate is going to go through a similar transition, and it might be um a longer, and this makes sense to me, thinking of it as, real estate in general is a longer term investment no matter what, most of the time. I'll say most of the time. I guess it depends on the market um, that you're in, but for most people, that's a long term play that can really um, pan out if you're patient versus something that you're going to, thinking it's going to be something that will, on the one side, the rumblings you're hearing about it taking out the entire banking system or something like that. I'm hearing from you that that's not necessarily in
Correct.
the cards or on the table.
Yeah, that's my opinion. I don't think that it's going to be a systemic issue for the banking industry. People are bifurcating large banks into regional banks. Regional banks do have a lot more exposure to office real estate. And so again, some of those may suffer. But who knows? I'm guessing there's some private equity groups, just like the one that, the three this week with NYCB, that are standing in the wings waiting that they can pick up some really good assets cheap, to help work those out, to give them the time to work those out. So we'll see. It's particularly with interest rates on the way, purportedly to be on the way down towards the end of this year. That is very helpful to real estate values, and values of loans as those interest rates start to come down. It increases the value of those loans on their balance sheet, so it doesn't make it look so bad.
Okay, so that feels like a little bit of good news too. Ish.
It's still a gray cat. It's still a gray cloud, but I would say a little bit of silver lining.
All right, there we go. Being optimistic here. So the other thing, we have another really good topic for today. And what's that?
Yes, that is productivity. So productivity is incredibly important. There's only a few ways to generate economic growth out of an economy. It's the amount of labor, the amount of natural resources, and the technology that goes in to converting those natural resources into products and services. Productivity is one of the things in an economy that can help raise living standards in a meaningful way. Now, from an investment standpoint, living standards are great, but I'm really caring about what happens to the stock market, bond markets. Those are the areas that I invest in, right? So productivity, if you track equity price returns on the stock market over low productivity periods and high productivity periods, higher productivity periods lead to far higher equity returns. Okay. Why? Well, most likely because this technology, that helps us to save on labor costs, right? We can now produce the same or more amount of goods and services for the same amount of cost or less, right? By using new technology that allows us to earn more money. So our earnings, our net income goes up, our earnings go up. If our earnings go up, our stock price is more likely than not going up. And so across the entire industry and the entire stock market, technological innovations lead to labor savings. Those labor savings increase earnings, which then increase stock prices. So as we talk about, I've heard a lot of analysts and economists talk about AI, artificial intelligence, and that is one aspect of what I'm referring to. I believe it is the combination of artificial intelligence, the Internet of Things, and robotics. The combination of those three will generate a massive amount of labor savings for corporate America over the next really forever, but kind of starting now, but accelerating in development over the next 5 to 10 years, which means over a longer period of time, equity prices are going to go up because earnings are going to go up. And so that is, when we talk about the equity markets and all those things, it's important to have a longer term context to what is going on. And if you look to the 1990s as an allegory, not an allegory, as an example of the US stock market and economy going through an innovation cycle, right? The beginning of the 1990s, the internet was very, very small. It was not very well adopted, both by any companies or individuals. You compare that to the end of 1999, and everybody was on the internet. You were emailing your friends. You probably had a MySpace account or a Facebook account, And so there was very, very little. Actually, Facebook wasn't even around. So,
I was gonna
you know,
say, no, MySpace, I think, was there when I
yeah,
was in high school, so that was late 90s, but Facebook wasn't there until about 2005,
yeah,
I
I think
think
that's
2004,
right.
2005, is when
So
Facebook came around.
MySpace was it. You were
MySpace.
logging in and going on to, you know,
AIM chat, your AIM ID, your AOL chat, yep.
yes, your your search engines, which, you probably were using Yahoo and a couple of other ways. But
Asking
so
Jeeves.
Ask Jeeves, that was a good one. I like that one. But um, so it, it was very different, and and companies could do a lot because they didn't need as many employees to function. And that's what we're going through right now. I think the 2020s are going to be very, very similar to the 1990s when all is said and done. And the 1990s was a very, very explosive time for growth. Now, we might have certain bubble periods within this time. We certainly did in the 1990s, and we certainly probably are going to have with today. Um, and so it's just some of those things that we have to kind of watch out for, but the general trend and the context of the trend will be labor savings, higher productivity, higher earnings, higher stock prices.
One of the things that I wanted to bring into the conversation, so I'll mention my husband Adam. I've mentioned him a few times. I believe, at least on the podcast, he is a ServiceNow software developer. So he specializes in ServiceNow, which is a huge platform with lots of moving parts. And ServiceNow is really pushing AI, or really like their AI instance and how it integrates into their platform in different ways. And bigger companies are now starting to look at this. They're pushing it really hard on the sales side. Companies are looking at it to buy. This is enterprise software. It's very expensive, and the purpose of it is meant to lower labor costs. Exactly what you're saying, to replace some of the more like data driven work, or I don't want to say menial, but the things that are
The more repetitive tasks.
repetitive tasks, right? And from his perspective, seeing it being like on the ground basically of how it's being implemented, and then also talking to the people who are looking to buy these things, right? So he's looking at it from these two perspectives, saying, "Hey, we actually have to be implementing this software perfectly in order for the AI to then come in and do its job correctly." And so you can't have a messy instance of ServiceNow. You can't have a lot of like add-ons from developers who have like, well, we did this to make that work to fit into this old system, and we did this work around here and this work around there. AI needs a really clean slate right now in order to be able to work and function properly, to do what it says, what these companies are saying it can do. And so from that perspective, thinking that there's not, um his thought is like, is it really going to be that much of a labor savings when you still need people there to manage things as they're moving through? And I thought your response to that was really insightful in how this has happened before. So, like you were saying, maybe not right now, right? These companies are probably, yeah, they're going to buy, these big enterprise systems and start, trying to implement them, and it might not show the savings that they're thinking, especially in labor cost, right away, or even in the first few years. But then, I'll let you finish the story there. What happened before with the
Yeah, I
internet?
mean, so in the 1990s, this is exactly what happened is uh, companies are always forced to buy the latest technology because they don't want to be left behind. And AI and the Internet of Things and robotics are forcing those capital expenditures on large. It starts with larger companies, but then it filters down to smallers eventually. But they get all these nice new systems and technologies and innovations, and they do start to implement them, but it takes pressure. It takes an external force to force them to use it to its best use or its optimal use. So in the 1990s, everybody bought all this technology and used it. They definitely benefited from it. But really, when they saw the massive labor savings was when we went through the tech wreck. You go through recessions, you go through hard times in the economy, and then it forces managers to go, okay, we have all this technology. Why do we don't need, we need to use it. And maybe we don't need some of these other individuals, employees that these technologies can replace. We saw a great, very short example of it in the pandemic when we had all of these video conferencing technologies already. We just didn't use them as much, right? We did them for, maybe a board meeting here and there. We did that kind of thing if people couldn't be together, but we already had that technology. It just wasn't rolled out to the general public yet. Well, the pandemic comes in, all of a sudden it's spread out. You have Zoom came up, Microsoft Teams really got on the stick and started competing. GoToMeeting all of a sudden had competition. You had all of these different companies that had offerings prior to the pandemic, but the pandemic forced companies to use them and to make use of them and to in this case, to offer flexible working arrangements where people could be in disparate locations and yet still collaborate and work on projects and products and services and work with clients themselves. And so that's what's going to happen with AI is you're going to see this, everybody's going to buy a ton of it. And it's really in the later years that you're going to see the massive benefit of it. And you're going to start to see, jobs be replaced that do the repetitive tasks that AI can do easily. Excuse me.
Yeah. So we can't predict the future of like, what's that crisis going to be? What's that going to look like? But just knowing the history, right? Even over the last 30 years, as the internet really has come online and really shifted the way we do business. I mean, we wouldn't be doing this podcast this way, right?
Correct.
Like
Right.
we couldn't do that. You're in Utah, I'm in Ohio.
Right. Exactly.
So yeah, I mean, it just really has shifted everyday normal life for a lot of people. Um, with how these technologies have really exploded and then iterated. So I think your example was really good about, remember WebEx is one of the one, I think that was
WebEx.
Cisco.
Yeah.
Um,
That's the one we couldn't remember the name to.
yeah, because that was the first one when I was, at my old company, old firm. That's the one that we were allowed to use. And then Zoom came online during the pandemic. Like you're saying, it was there before, but really started to be used heavily. And then from there, we started to see, oh, this isn't just helpful for remote work. We can actually do a ton of stuff with this. And so, yeah, connecting with people from all over the place, webinars as a normal thing, mastermind groups that can, pull together people with similar interests from all over the world, right? Started to be a thing that none of that could have been that easily done before, where, those groups would meet in person, right? You think of a Vistage meeting or, other like a BNI meeting, all that, like everything was in person. Okay, now we can open things up in a whole new way when we utilize this technology differently. And so that's what I'm more hearing from you is that it's going to take some sort of, AI is growing. It's having a huge impact in different areas already, especially in the stock market and some of the companies that are focused on AI, right? They're seeing boost right now, but we might not see the full adoption and impact of it for another, at least 5, maybe 10 years.
Yeah, and it's going to go through iterations. Like right now, if you've noticed, like the chip makers that facilitate artificial intelligence are the ones are the stock prices that are taking off, right?
Mm-hmm.
Well, that's great, but that's not what's actually going to make a lot of money using AI. Okay. Right now it's the infrastructure. So you have the chips and the like. It's going to morph into the apps or the applications, and then it's going to morph into how industry can use it. And those that process, those three different waves are going to happen. We are at the beginning of the first wave. And it's been a very long wave because artificial intelligence is not new. It's actually been around for many, many years. In fact, I think the first movie talking about artificial intelligence is in like 1953.
Mm.
So we're going way back when people had anticipated artificial intelligence being combined with robotics to do certain things. I mean, if you look at the Arnold Schwarzenegger or
Terminator, yeah.
no, it's not Arnold Schwarzenegger. Anyways, if you look back at Skynet, the movie that featured Skynet taking over the world and trying to destroy the humans, that's been in science fiction for a long time. We're not close to that. We're not even like that's so far in the future, but can it be a very helpful tool? Absolutely. Does it have risks? Yes, because AI is at the base of it is an algorithm that uses probabilities to guess, to predict something, whether it's the next word you're going to type or whether it is the next idea for you to do something, right? It can be very, very helpful, but it has to be in the context of what it's learned already.
Mm-hmm.
So if what it's learned already is incorrect, then it's going to give imprecise, incorrect predictions. And so that's where at this point, I think it's going to be extremely helpful. I think it's going to save us a lot of money in terms of labor, but we're at the infancy of the actual trend of commercializing artificial intelligence, robotics, Internet of Things to help corporate America boost their earnings and really become much, much more productive for shareholders.
Mm. Well, I think that is a good place to wrap up for today. Super interesting to kind of think about all of these things together, like kind of where growth is headed in the future. So as always, if you have any questions at all, I am happy to receive those. Brad is happy to receive those questions too. You can reach out to me directly at Hannah, HANNAH, at expansiveceo.com. And you can put question for the podcast in the subject line, and we would love to answer it for you. Brad, how can people get a hold of you?
You can get a hold of me at B Haines, BHAINES, at juncturewealth.com. Or you can look on our website, which is www.juncturewealth.com. You can find me both places. It would be great to have questions from the audience. That would be fantastic. And no question is too difficult or too simple. All questions are important, and we would like to answer those for you. So please let us know what we can do.
Absolutely. We're not going to tell you what stocks to invest in. That's not what we're doing. But
Yeah, we're not your
beyond that,
advisor yet.
exactly. Well, thank you so much, Brad, for being here with us again. And we will see you all next week. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.